Hello and welcome to the Consumer VC. I am your host, Mike Gelb, and we're going to be diving into the world of venture capital and consumer-facing startups. Our guest today is Mike Ghaff, general partner at Canvas Ventures, one of the premier early-stage thesis-driven funds invested in fintech, digital health, marketplaces, and new enterprise. Prior to Canvas, Mike was a general partner at Social Capital, and as an angel investor, some of his investments include Strava, Skip Scooters, Pocket, Atrium, Phil's Coffee, and Superhuman. He also has 10 years of operating experience as CEO of E24, VP of Business and Corporate Development at Yelp, Director of Business Development at TrialPay, and co-founder of Stitcher and BarMax. Quite a remarkable resume, if you ask me. In today's episode, we're going to be mostly focusing on how to evaluate online marketplace businesses. Mike has written a few articles on marketplaces for Forbes and on his Medium account. And for this episode, I would suggest checking out Mike's article, Where I'm Investing and 15 Marketplace Questions. The link is in the show notes. I learned a lot chatting with Mike, and I'm sure you will as well. So without further ado, here's Mike. Hey, Mike, thanks so much for coming on today. How are you doing?
I'm doing great. How are you doing?
Very well, thanks. Very well. So you've been the co-founder of Stitcher, the CEO of Eat24, and a successful angel investor, and now you're a GP at Canvas Ventures. So just take me a little bit inside your journey and what attracted you to working in startups, founding your own startup in the first place.
Yeah, I got the startup itch very young. I first started hacking on computer games when I was about 12 or 13 years old and taught myself assembly language and programming then. So I've kind of had this fascination with technology and, software, computers, and apps in particular from a young age. And then when I went to college, or actually in business school, I took a class on managing networked businesses by this professor, Tom Eisenman, who did a lot of groundbreaking research in this area. You sign up for this class, it's called Network Businesses. It sounds like it's, something on Cisco or like routers. But I kind of learned that it was nothing of the sort. I think some students were surprised actually that it wasn't about that topic. Cisco was still an exciting company to a few people at the time. But actually it was about this concept. In particular, a lot of marketplaces were covered. So there's network effects like Facebook famously has, where you have one-sided network effects. The more users are on Facebook, the more valuable it gets for every user. The seminal example he used was his fax machine. But the professor also introduced this concept of two-sided networks. And those are, marketplaces where if you add supply and you add demand, it gets more and more valuable for the other side. They're called cross-side network effects. So that got me kind of interested there. So I kind of had this startup interest. I did my first startup in college. And then, in business school, when I learned about these marketplace things, I got really fascinated with that. So, that brought me to investing in that area as well.
That's awesome. That's awesome. And I know you have over 10 years of operational experience. How important do you think is having operational experience as an investor?
Yeah, it's a great question and something I thought through quite a bit. I graduated business school, and at first I went to Summit Partners, which is a long and storied investment firm where I got great training and met some great people. But when I was there, I think I started there and I was 25 or 26 years old. I was very young because I'd gone to business school young. And I thought, man, I don't know how much value I can really add. Like if I ever served on the board of one of these companies, I would meet these 40-year-old and up founders and CEOs. And I thought, look, I think there are people who get there, you work their way up just purely through the finance route. But for me, for the kind of VC I wanted to be, I thought I'd like some more operating experience. I'd done a small startup in college, worked for a software company for most of my undergrad, but I hadn't really cut my teeth at big, high growth venture-backed businesses or really started meaningful companies on my own. Outside this college one. So I said, A, I want to be an earlier stage VC. Summit was kind of growth fund. And B, I want to get more operating experience. I thought I would only do a few years of operating. The plan was to always kind of go back to investing, but I had much fun, largely with Yelp. I spent 10 years operating. And then finally, I kind of went back into investing in 2017. And I think for me, it just suits my personality. I really enjoy meeting new founders every day, learning about new business models, kind of getting to apply my brain in that way instead of kind of just sticking with the same problem for years on end, which is, as a founder, you have to have that level of perseverance for one idea. You can expand it and grow it, but you're really, really stuck to one idea, one market. And for me, it was kind of liberating to be able to look at lots of stuff and also to have an impact and help lots of founders if there's anything now that I've learned, now that I did get all that experience, if I can share that and help founders on their journey, that's very rewarding for me.
That makes a lot of sense. I understand that two of your main focuses in terms of investing are consumer tech and marketplaces. What makes you excited about investing in consumer in this current climate?
Yeah, well, one thing, I think it's a great time to be investing in consumer because it's a contrarian time to be investing in consumer. So, everyone, especially now, just even in the past couple of months, what's happened in the public markets around unit economics, gross margins, pressure on Uber and Lyft, and everyone loves it. Meanwhile, you look at some of these enterprise software companies like Datadog and Zoom, and people are very excited. They've been reminded what a high margin you can have in the software business and B2B software specifically. And so a lot of consumers and, people, kind of the tourists who were just coming in to look for a flash in the pan consumer startup, they've kind of shaken out. But this is where some really exciting consumer startups could be built. And if you look historically, by the way, the same has been true every economic cycle, is every time people kind of have soured on consumer internet, some of the best, most interesting concepts have been built right around that time. After the kind of 2001 dot-com bubble burst, a lot of interesting startups came out right after that. Yelp, which I'm very close to, that idea started in 2004, just a couple of years after that market meltdown. And then, LinkedIn, YouTube, several others followed, and then Facebook, of course. Even though counterintuitively, it's not a great time for some consumer software businesses in the public markets, it's actually, could be a better time than ever at the seed and Series A stage.
Got it. Wow. Thank you. As you know, I wanted to focus our conversation on marketplaces since you've written a lot of material on the subject. So let's start off with, what is a marketplace?
Yeah. So I'd say a marketplace is anytime you've got two sides in a two-sided network, and they're matching together. And by the way, we're talking about online marketplace business models, usually, to use kind of a more wordy term, but people usually shorten that to marketplaces. And so you're in these online marketplaces, you're using software, be it a mobile app or a website or something else, and you're matching these two sides to help them transact. Oftentimes they're called supply and demand. There's three rough categories you could put these in. So the classic one is matching supply and demand for buyers and sellers. That started with eBay. The really interesting data point a lot of people don't realize, and I've written about this, is Amazon is actually now more than 50% of the revenue comes from the marketplace business model, not the traditional online retail. So eBay, people were very excited. It was supposed to be, one of the biggest companies ever, and it did grow very well. Amazon eclipsed it, but not the pure Amazon model. It was actually, in a way, eBay's thesis had the last laugh, because this Amazon marketplace of opening up to other buyers and sellers became a bigger business. So that's this kind of product marketplace, right? Or you've got, tickets with StubHub. You can think of a bunch of different categories. But there are also this large category of services marketplaces. So, those can be, particular kind of labor, 1099 contractors, or other forms of services like Uber, Lyft, TaskRabbit, and many others, where you get matched to a service provider who can help you out. And then finally, whether you put this in the kind of product or service bucket, or you create a new category of its own, there is a rental marketplace, or just matching someone with something they want on demand that's not somebody's labor nor a simple product, like Airbnb. So, hey, I want to be matched with a place to rent. By the way, those are the consumer marketplaces. You're focused on consumer, and that's what most people are aware of. There's also another category we can talk about and save a letter, which is B2B marketplaces. And, for example, enterprise labor marketplaces, like nurses and matching nurses with hospitals. But we can focus on the consumer ones. And those are frankly the larger ones now and what people are most familiar with.
Got it. Thank you. And I appreciate all the examples and your breakdowns. So what makes marketplaces such attractive businesses to invest in for venture capitalists?
Well, this is the cool thing. I had no idea when I was taking this class. I think it was in like 2004 or 5. I'm taking this managing network business class with Tom Eisenman. And I don't think I was taking the final exam on network effects and looking at early marketplace business models. And I didn't realize what an impact this would have later in my career. But I was learning the academic framework then that I saw in the real world later. There's just a lot of stickiness and lock-in. When you build up a lot of supply, We can take the Uber-Lyft duopoly, for example. It's exceedingly hard, and many have tried to come in and create a new marketplace for on-demand drivers, because Uber and Lyft, and that's an interesting case where two of them ran really quickly and got it, but they were able to run so fast that if you're, think about, you're a passenger and you want to ride, even though it would only really take you like 60 seconds to go download another ride-sharing app, maybe, put in some details and try and hail a ride, you won't even do that modicum of effort, 60 seconds of effort to be exposed to marginally some more drivers. Even if it was like 5% more drivers, you probably wouldn't do it because you're covered with Uber and Lyft. They have such a critical share of the supply of the drivers on the network that that's the place to check. And it's not even worth like 60 seconds of your time. In fact, there's some people that might only go to Uber because they're a little bit larger and they won't even check Lyft, and vice versa. Some people develop an affinity to the other. Similarly, for on the supply side and the drivers, they're thinking, well, why would I go drive for some other service and like run this app and try and find passengers? All the passengers have just come on to Uber or Lyft. And so you get this kind of catch-22 for any new entrant, or a chicken and the egg problem is, how are they going to jumpstart supply and demand? The early market entrants, or whoever, it's not always first mover, but first to scale for a marketplace gets the advantage. And that's why in this environment of abundant capital, you've seen companies really rush to raise money very quickly so they can be, even if they're not the first mover, the first to scale, because they know how important that is. And once you get that supply and demand, you just have such strong defensibility. And so as an investor or an entrepreneur trying to start businesses or invest in companies, you really like defensibility because that's what's going to lead to a large, enduring, public company to provide a return for your dollars or your labor, as opposed to a lot of other business models that have far less defensibility, are prone to being kind of copied and ripped off pretty easily. And those businesses are just less interesting to invest in.
I love what you say in terms of, evaluating switching costs for consumers for first to scale of, downloading a new app that's not Uber and Lyft, and same for the driver to run through a new interface.
And the funny part there is, like in business school, switching costs we'd look at would be more real. It would be like, with the fax machine, which is a one-sided network, not a marketplace, but it was like, hey, if you're going to switch to a totally different protocol and you have to buy new hardware, like there were much larger switching costs. The crazy part is, even as switching costs have got down to this small units of time or effort, they're basically free. It shows you how sticky these things are because people don't even want to put, tiny switching costs. You have to really, really be frictionless and have zero switching costs to get people to switch. And it's very rare to have true zero switching costs.
That's a great point. Because the switching costs really aren't that much, just because, as you said, it only takes a few seconds to download an app and actually go and maybe present your credit card information. You wrote a great article. Well, one of many great articles, but the one I wanted to focus on was the 15 marketplace questions that you had. I believe that a founder or investor should be asking themselves when analyzing marketplace opportunities. Would you mind highlighting just each of those 15 questions?
Yeah, absolutely. So and by the way, if you want to just kind of follow along, you can go, if you're listening to this, you can go on Medium, just search my name and marketplace checklist or marketplace questions, and you'll find this article. And basically I say, okay, if you are going to analyze a marketplace business, what are some top questions you want to ask? One of the first ones I start with that's often overlooked is, which side of the network values the other side more? To put it a different way, it's important to realize when the demand side of the network values the supply side more. Because in that case, it's all about bringing on supply when you want to scale your business. And Uber is just like this. Uber, I was friends with the head of growth for Uber, and he was trying to get more demand. And he said, I realized I should just stop trying to get demand, and almost all my effort should be trying to get supply, trying to get drivers. Because if I can get the drivers, the passengers will follow. And that's a clear indicator that one side, in this case, the demand, values the supply more. And what you do in that situation is you typically subsidize the supply side, that more highly valued side. So since these drivers since the passengers are valuing these drivers, you want to pay, like Uber and Lyft famously did. You make these, $500 guarantees, say, please come on our network. That's going to get the supply jump started so that you can now get demand.
One of the questions that I thought was very interesting was about a proprietary method of distribution. Would you mind just elaborating the importance of proprietary method of distribution?
Absolutely. And I think a classic case for this is, I was at Yelp for 7 years, and then we acquired a company called Eat24. And we met E24 when they were a tiny little company. I first got to know the founders. I think they were under 10 people in the team, under $1 million in gross transaction revenue. And then we partnered with them. We said, hey, we're going to launch a transaction platform at Yelp for a lot of marketplace startups, actually. These local on-demand marketplaces that wanted the ability to have their users transact right within the Yelp app. So with E24, a food delivery app, you could find a restaurant on Yelp, and without ever leaving the Yelp app, you could order food delivery powered by E24. E24 would go sign up the restaurants and the supply. Yelp had those users. So Yelp was this really interesting proprietary method for distribution. And the interesting thing is this tiny little company got on our platform, and pretty soon they became our largest platform partner, and Yelp became their number one new source of users. Over 30-40% of new users were coming directly from Yelp. That didn't even count all the indirect transactions they were getting, which were maybe a majority from Yelp. That drove down their blended cost of acquiring users significantly. If you're coming in the horse race in any consumer app, forget about marketplaces. I mean, including marketplaces, but any consumer app, and you're just having to pay the market rates on Facebook or Google to acquire users, you're going to get crushed. You need, by definition, when you're in front of the consumer, you need some kind of proprietary distribution model. We learned this at Stitcher, and we did it through partnership and other means, and we could talk about that later too. But it was exceedingly difficult. But E24, getting back to this story, they had it locked in with this Yelp thing. And so by the time we acquired the company a few years later, they'd actually reached, gone from that 1 million or less to 150 million in gross transaction volume annualized and 150 employees. Then they asked me to be CEO of the company as a subsidiary of Yelp, and we grew to 700 million in gross transaction volume in 2 years and 500 employees. And again, this was all because we had this special distribution model. So, I can give you many other examples, but I think it's really, really critical that you find a way to get in front of your users, in some way that not everybody has. Now, one caveat with my checklist, I put this checklist out there. Not every business checks the box on every single question with flying colors. It's more like, for out of 15 questions, if you can do really well on 10 of those 15, that's really compelling. If you don't have good answers for, 12 out of the 15, that's when you start asking yourself, hey, do I have this particular marketplace figured out? But it's not like you're going to get 100%. Uber, for example, didn't at the get-go have an obvious, unique distribution model. They were just referring friends. They really harnessed the power of referrals, and that helped. I don't know how unique you would call that. Maybe it is. But part of it was they were just a better mousetrap, and there weren't a lot of alternatives, and people couldn't find taxis in key cities like San Francisco, and so they just jumped on it.
So do you mind also just talking a little bit about cross-site and same-site network effects and the distinguishing the differences?
Yeah. So the next question I asked is, how strong are cross-site network effects? And is there a metric that can measure that? How has that tracked over the last year? And there's also this concept of same-site network effects. Cross-site network effects are the supply and demand, where one side of the market, like the E24 restaurants valued the fact that users were coming on E24. And then the flip side is, the users value the restaurant. So that's a cross-site network. You add a new restaurant, the users are happy. Hey, more dining options. You add a new user and the restaurants are happy. Hey, more revenue, more eyeballs, more mouths to feed. Or that's cross-site. Same side is like this fax machine example I was giving. There's not a two-sided thing. It's just the more users have fax machines, the more valuable your fax machine is because you can fax more people. Now, that's an old example. A lot of founders today maybe have never even touched a fax machine. But Facebook is a really good example for this. Yeah. The more people that are on Facebook, the better the product is, right? There's more people to connect with. Now, there's all these interesting questions. So one question you want to ask yourself is how strong the same-side network effects are. Are there diminishing returns on it? For example, with Uber, at some point, you don't care about having too many drivers. On same-side network effects, like with Facebook, there could be, like diseconomies of scale, if you think about it from a user perspective, where you don't want actually your mom to be necessarily connected to you on Facebook, right? Or that aunt, that you don't always keep in touch with. Like some people get off the network and then they start getting more on Instagram or trying something else. And actually in a marketplace, you see this sometimes where the same side network effect could be negative actually. So for more drivers, I frequently will hear Uber drivers complaining that Uber let too many drivers on the network and they're hoping there are going to be some limits and there are some safeguards in place. So that's interesting to see how the same side might actually be a negative effect in a marketplace.
Wow, that's really interesting. I never really thought about the negative same side network effects. What are maybe one or two questions for those that are interested in starting marketplaces? What are maybe one or two questions that you think that founders might have overlooked or haven't thought about?
Yeah, so I'll give two. One is, there's all these obvious ones that you should ask yourself that I think most people have done, like what's the frequency of use for your demand and supply side? You can measure that in like transactions per month. What's the average transaction size for demand and supply? What's your take rate and what's a sustainable take rate over time? Does it get easier to acquire incremental supply and demand as the marketplace grows? That's a good sign. If not, if it's getting harder to acquire incremental supply and demand, you should ask yourself why that is. Should you focus on one or two geographies or categories to get started where you can get like a critical mass tipping point, strong network effect there and grow? So there's, do you have like an initial market winning strategy and then how do you scale? These are all like the basics. But two more nuanced things that I see a lot of founders miss. I'd say one is we talked about those cross-site network effects. Do you have a metric that can measure how that's tracking over time? For example, there's a company, Hubhouse, that I invested in, and they match people, their marketplace, to match renters, people who want to live in an apartment or a shared house. And they say, hey, instead of like in San Francisco, for example, a really expensive apartment, even if you split it 1, 2, or 3 ways, what if I could just go live in like a 5-bedroom house with 5 or 6 other people? A, it can be more economical, but B, more importantly, you can have the sense of community. So how would a business like that match its network effects? So it's matching houses with people and renters. And one way you could do it is you say, well, when somebody moves because they need to switch their housing arrangement, and you measure their NPS, they're happy. It's not somebody who's unhappy, but it's somebody who's happy. But they just need to move. Maybe they change jobs from the East Bay within the Bay Area. They used to be working in, somewhere like Emeryville, and now they're going to go work in San Jose, way south. It's too far to drive, and they were living in the East Bay, so now they need to move down there. Do they stay in the Hubhouse network, and do they switch to another Hubhouse, or do they leave the Hubhouse network entirely? And the interesting thing is, even though Hubhouse is only a few markets, and a lot of people move somewhere, where Hubhouse isn't even an option, we tracked that metric, and it went from like 1%, very low when the company started, to like, 10% and kind of beyond it. And, that's really interesting to say, hey, people are staying with this Hubhouse. Like even though they are moving, they're staying in our network. I think every business, every marketplace actually has a metric like that. It's just unique to each, and they need to find it. Like, how do you measure the network effect? So that's one. Number two, which is kind of related and is also you could develop a metric for it, is how do you measure liquidity for your marketplace? And there's a lot that's been written on this. There's an article recently, if you do a search online for like marketplace liquidity, that I didn't write, but someone else did. And one simple metric, like if you think about eBay, it's okay, somebody posts something to sell. How quickly can that person actually get that transaction closed? Or you go on to buy something, reflexively, and how long does it take for you to find what you want to buy? Uber is a great one. The minutes for you to arrive, that's the critical metric, right? That's a huge liquidity metric. If it's over 10 minutes, that means there's not good supply liquidity, and it's harder for transactions to clear. If it's down to 2-3 minutes, Uber's metrics in that market actually skyrocket, and that's what true liquidity looks like. So again, you have to custom tailor that for your business model.
How do you think for marketplaces? How do you think about product market fit? Because of course you have to look on both sides, the supply side and the demand side.
Yeah. So I'd say number one is that do you have this effective method for distribution, right? Ideally proprietary, and as I point out in this checklist, it's for each side of the network. So it's not enough to just say, hey, I can get a bunch of demand, like I can get a bunch of users onto my app. Can you actually get supply and both sides of the network? I think that's key. If you can do it in a repeatable way, both organically and maybe through some paid channels as well, but you show that it's at a reasonable cost and you can show the lifetime value of these users on both sides. In marketplaces, we have what we call like a fully loaded LTV to CAC, so not just your normal, sometimes people will say, hey, here's my cost to acquire a user on the demand side, but they completely neglect, and then they say, here's the lifetime value of that user. But they might have completely neglected to mention that they spent a lot of money to get the supply side to service that demand side user. So if you actually have fleshed a lot of this stuff up and then you're getting liquidity, and then, at Series A, you're usually looking for at least 1 million, if not, single digit millions in gross transaction volume on the marketplace side. Ideally, another sign of product market fit is that you've actually managed to have a take rate you as a marketplace are providing enough value that you're taking, let's say, 10%, as E24 did in the early days, and then or Grubhub was doing around 16%, a few years ago. But you've actually got, Uber has been 20% and moved around. So you've got somewhere in that neighborhood. It's always a question of product market fit when there's a marketplace, but they're not taking a take rate yet, because you don't know if the users on both sides actually value the marketplace enough to be willing to let them have that take rate.
So in terms of for marketplaces, you could have, a high frequency number of transactions, but, small amount in terms of the actual transaction side.
Uber, right?
Right. Or, small amount of transactions, but large transaction sizes.
Airbnb.
Right. And so what do you think, and maybe there isn't a real answer, but what do you think when you're analyzing marketplaces is more valuable?
I would say ultimately frequency is probably a little more valuable, and I'll tell you why. I'll invest in a marketplace with high frequency but low transaction. Like let's say another Uber style model. Uber's gross margin, issues that everyone likes to talk about in the press these days notwithstanding. If a marketplace has too low of a frequency, no matter how large the transaction size is, it's tough to develop that stickiness with your users because they're not doing repeat transactions. They almost forget your brand. Like if you're going to buy something on that marketplace only every few years, or you're only going to have a reason to look at it every few years, it's going to be much harder. But Airbnb, for example, you still might travel, and they put out stats on this, a few times a year. It's enough. And especially on the supply side, you're renting out to people all the time. So Airbnb's got the level of frequency that works, even if it's not as frequent as Uber. But there are counterexamples to this. You can work, I invested in Fly Homes, which is not strictly a marketplace, but Fly Homes is a really interesting consumer, app that's helping reinvent the home buying process. They help people, especially first-time home buyers, make an all-cash offer on a home, for example. And that way they can get much more certainty to close in tight markets like San Francisco, Seattle, where they launched, or, even where you are in LA or New York, other places they haven't launched yet, but you can imagine those dynamics. They also help people give a guaranteed offer on their current home if they're trading up to a new home. And then that way they have confidence to be able to know what they can afford and trade up to the next home. So they provide this great service. But if you think about it, when you're moving homes, you don't do that often. It's not going to be multiple times a year, certainly. Hopefully not every year that you're doing a home transaction. But it's a big enough purchase. It's so important that even if it's every few years, several years, they can stay top of mind. So there are exceptions to frequency, but in a lot of categories, if you're too low frequency, that could be the kiss of death.
I hadn't thought about it before in terms of the value of the actual frequency of transactions. How do you think about online customer acquisition costs for marketplaces in this current climate, considering you have this duopoly with Facebook and Google, and with marketplaces, you have two CACs on the supply and demand sides?
Yeah. So number one is don't be reliant on just Google and Facebook. If you are, you're in trouble. And so there's a two-step process. Number one, develop organic proprietary models of distribution. For Yelp had SEO, E24 we talked about through like partnership and integration into Yelp. So it could be BD, it could be other kinds of organic things, partner marketing, a dedicated user base and email list. There's many, many ideas that you can come up with on the organic side, but that's really important. And the more proprietary, the better. And then number two is experiment with other paid channels. Don't just stick, and I help a lot of founders with this. Don't just stick with Google and Facebook. E24 published a great article on the kind of breakup with Facebook when Facebook rates were getting too high, and it got a lot of press attention. And we still came back eventually to experimenting there. But it was there's all kinds of offline marketing and other channels that are getting more and more measurable every day. TV, outdoor, radio, print, mailers, and other digital channels as well outside of those two. So I think in every era, every company that's been built and has done paid marketing has found unique sources of paid marketing that everyone else wasn't picking up on. Because if you're just paying the market rates for that duopoly that you described, Google and Facebook, you're going to get hosed. It's not going to be a winning game.
Right. What are some of the challenges in analyzing, B2C marketplaces versus B2B marketplaces?
B2B marketplaces, it's just very different. One is you're not going to get the kind of consumer mind share that you're going to get with B2C marketplaces. So you've got to find new marketing channels. We were just talking about, you've got you got to think about like, okay, do I have a sales model where essentially I'm doing sales in the supply side? And then how do I find the demand? In this nursing example, like how am I going to tap into millions of nurses? How am I going to sell into hospitals? It's just a very different, sometimes some of these, call themselves SaaS enabled marketplaces. And sometimes they behave a little bit like SaaS companies as well. It's a different kind of animal than the typical consumer playbook for B2C.
So what are some of the qualities that you look for in founders when you're analyzing companies, especially at the early stages when you might not have a ton of data to go off?
Yeah, I mean, this is a great question. And I think so much of it when you're evaluating a company at Series A is the founder. So I'd say number one, tenacity / like grit, perseverance, whatever you want to call it. But I look for that in their personality, and it's both with their current startup, but you can look for a lot of these. You have to, you reference check, you ask around, you look for things even when they were younger to see the total profile of the person. And that tenacity is extremely important because I've been there. It is a hard job. You're constantly going to be banging your head against the wall. The analogy my co-founder at Stitcher gave me that others have used is it's kind of like rolling a boulder up a very steep hill. And every time you push it, one step forward, it feels like it rolls 2 steps backwards. And now you're even lower, and huge rock you can picture just in front of you, crushing you. The amazing thing is eventually you might hit a tipping point where it just feels like you're rolling downhill, and it gets that much easier. And then you get momentum. That's the growth phase. And you raise a big round, you pour money into it, add fuel to the fire. But at Series A, they're rolling up that boulder for a very long time. So tenacity is key. Number two is expertise in an area, ideally the area around their startup. Maybe they have some technical expertise or some business expertise. Maybe they've just recently developed that expertise. And because more what I'm looking for is not that one area, but the ability to quickly develop an expertise in something and get obsessed with an idea or a discipline or a field. And so you can also, if they're new to the startup they're doing, you can look at again, through the rest of their history before you find the founder, ask them what else they've become obsessed with and thrown themselves into. And if they have this tendency to be a self-learner, that's very critical. Number three is just signs of an outlier. I mean, I'm a repeat founder. Founders, myself included, like we're weird people. You're not your normal people. If founders are normal people, we'd have a lot more founders and a lot less like employees. There's a reason a tiny fraction of the population are founders, and successful founders, are even less. And so you're looking for a spiky personality that's all, I've seen founders who almost seem like they're purposely trying to be quirky. That's not what I'm saying. But you do look at the person's whole life story and you say, does this person seem like an outlier in some way? It's not always, test scores and raw intelligence. That's like one path that some people have, but, or, being a prodigy or something like that. But there's other signs that the person just stands out and they're not the norm. They think differently. They think outside the lines, hopefully, ethically and legally, but they think outside the lines of current accepted norms.
Yeah, I think those are some great points. What are some consumer trends or opportunities that you're excited about?
I'd say two big ones. One, just, as is obvious from the rest of the talk, is the next generation of big on-demand consumer marketplaces. So you might call that marketplaces 3.0. Like I said, I think these could be hiding in plain sight right under, and everyone's kind of focused on B2B more. And by the way, I'm also very interested in these B2B marketplaces. We're seeing this explosion in labor marketplaces, but marketplaces 3.0, if 1.0 was eBay, 2.0 was, Uber, Airbnb, Lyft, and that cohort. I think there's going to be a 3.0, whether that comes from a platform shift, which is not obvious what the next big platform shift, or, there was desktop web, there was mobile. It's not obvious the next platform shift yet. So it might be another trigger. But I think that's really interesting. And then number two, where I've been spending a lot of time with my Fly Homes Series B investment, and then before that, Hub House investment, Cloud Kitchens that we invested in social capital, real estate related software and technology. Some people call it prop tech, but I think there's a lot of interesting consumer stuff you see now. There's going to be kind of an explosion. It's such a very, very large and inefficient market, such a huge asset class. And I think we're just scratching the surface of, Zillow and Trulia, Redfin, where the kind of early wave, and now you've seen a bunch of new models, but I think there's many more to come.
That's awesome. What's something that you would change when it came to venture capital?
the speed and the kind of a transparency around process and how it works. I feel like so much of this is so opaque to entrepreneurs. They go and they email, they'll get ghosted by their VC, right? And they don't know what happened and they don't know why, and founders will consistently say that a quick no is so much better than like a slow, drawn out, who knows, maybe. And yet it's as if some investors are really making it hard for founders. They want to make them jump through hoops and make that. And I think sometimes they might not realize, I think having been on the other side and having been a founder myself, and having been, strung along before, I understand how valuable a quick answer is and quick feedback and, iterating with folks. So of course I'll get burned. I'm sure a founder who I haven't been, 1 week, maybe I was sick or something, and they'll say, hey, you didn't move as fast as you could have with me. We can't always be lightning fast, but I do think the industry is still way behind where it needs to be in terms of accountability and the pace. No,
that makes a lot of sense. And just a bit of a follow-up question to that. When a venture capital fund tells a founder, we love you as a founder, we love the product you're building. However, we need a lead investor in order to invest. What should be the founder's reaction to that?
Well, so I think we have to break this down into like seed stage and then like series A, B stage. Generally at series A or B, you should only be speaking with investors for the most part who could lead your round. You probably shouldn't even waste your time with them. So if, that should just be a qualifying question before you even get an intro to the investor is like, do they lead rounds? And typically they'll take board seats. If the answer is no, you can talk to those folks later to fill out your round. And oftentimes you might talk to like friends of your Series A if you want to, but it's a waste of time because there's so many. I mean, that's what we as Series A investors typically are in the business of. There is a kind of a Series A crunch right now because there's been an explosion of seed capital, an explosion of growth capital. But in the middle of Series A and B, there hasn't been as large of a growth relative to those two other stages. But you should be looking for firms like us and partners like me who'll make that investment, take that board seat. At the seed stage, I will say it's a little bit different because there are these what are called party rounds where there's no real lead. It's beyond the scope of our conversation today, getting the whole debate of like pros and cons of these party rounds. But maybe, there's some investors asking that, or it's a fair question. Some people will advise you that, hey, if an investor asks you who else is in, you shouldn't talk to that kind of investor. And some investors pride themselves on like being able to say yes in the first meeting. Again, at Series A, it is less relevant because they should be doing independent work. And at seed, it really depends on you as a founder. Sometimes it helps the seed investor understand, the landscape better. So I'd say it's tricky. There are some times where a seed round would make the most sense to have an anchor tenant, that kind of lead, and then maybe you fill it with others. And maybe that's a fair question for an angel investor or a smaller seed fund to ask.
Now, since, as you said, there's an explosion in seed, an explosion of growth, how is that a good thing for you since you're focused on Series A?
Except for the fact that, it's keeping me out late a lot of nights and early mornings and makes it harder to see my kids and stuff. Like outside of the frenetic pace of being very busy, it's a great thing for a Series A and B investor. It does cause valuations to get a little nutty sometimes because that later stage stuff, everything kind of gets pushed up. So that is a challenge. There might be a correction and that does get tougher, but overall it's good for the Series A and B investor to have more inbound on the seed stuff coming in as it matures to A, and then more opportunities later to help raise growth capital.
Yeah, I could see how a Series A crunch would keep you really, really busy. What's one of your favorite books that has impacted you both professionally and personally?
Yeah, so I'll give two. It's an easy. One is Give and Take by Adam Grant, about being a giver and how you can still be successful. You can give without giving everything and getting taken advantage of. That was always innately to my nature, kind of a giver and giving a lot of my time and energy to friends and colleagues. And it was nice to see that you can kind of build a career around that. So I really like that. And that's kind of my model of venture. And then another one is Drive by Dan Pink, which is one of the few books I've ever found on the study of kind of human motivation and how to give people autonomy. And it's probably my top management book recommendation for people who are new managers or executives who haven't read it. So that's on the book.
Awesome. Thank you. Well, I know you have to jump, but thank you so much, Mike, once again for coming on the show. I really appreciate it.
Thank you so much. I appreciate the time.
And there you have it. It was an absolute blast having Mike on the show, and I really appreciate him taking the time. If you'd like to follow Mike, you can do @newmike. I'll have a few of his articles as well in the show notes for those that want to dive deeper into marketplaces. You're also welcome to follow me along behind the scenes @Mike Gelb and @ConsumerVC. If you enjoyed this episode, which since you're still listening, I hope you have, I would appreciate it if you'd write a quick review on the Apple Podcast app. Thanks again for listening, and until next time, folks.